Okay, so have you ever had that feeling that that knot in your stomach when you look at your bank balance after maybe spending a bit much,
Yep.
or oh man, the dread when a medical bill lands on the doormat? Just that feeling of ugh.
Oh, totally. That feeling is, yeah, it's pretty universal, I think. We've all been there.
And then there's all the financial advice, right? It's just everywhere. Feels like trying to drink from a fire hose sometimes.
Exactly. Just overwhelming. You end up soaked, but not really any clearer on what to do. More confused, maybe.
Well, if any of that sounds familiar, if you're nodding along right now, you're definitely in the right place today.
Yeah.
We're going to do a real deep dive. We're digging into some really powerful stuff, profoundly practical insights, actually, drawn directly from Scott Galloway's book, The Algebra of Wealth.
That's right. And our mission today, really, is to try and cut through some of that noise. We want to challenge maybe some, assumptions people hold about money and pull out the really crucial stuff, the actionable wisdom, stuff you can actually use.
Yeah, principles to help navigate, because it is complex,
Right.
right? Building wealth, building a fulfilling life.
And let's be super clear up front. This isn't just about getting a bigger number in the bank account. I mean, sure, that's part of it, obviously. But it's more about understanding how getting that economic security, that feeling of stability, can fundamentally free you up.
Free you up how?
Will free you up to have the time, the mental space, the resources to actually focus on what really matters.
Mhm.
Relationships, purpose, just living a life with less volatility, less of that constant grinding stress.
It's such a personal thing, too, isn't it? Like, Galloway tells that story about his own approach early on. He was all swing for the fences, high risk, super stressful.
Right, and he contrasts it with his friend Lee, who just consistently put $2,000 into an IRA year after year. Simple.
Yeah, and Galloway's pretty honest. He says, look, his way worked out eventually, but he got lucky.
Yeah.
Undeniably lucky.
Whereas Lee's path, way less
Yeah.
drama, right? Less
Right.
stress. It was this more balanced, more sustainable way to get secure.
It really makes you think, what's the right path for me? For you, the listener, there isn't just one way.
And the urgency for talking about this now, it couldn't be clearer. You just look at the numbers. The stats that came from the source material are, frankly, pretty stark.
Stark is the word. Like, median home prices now being 6 times median income.
Yeah, compared to 2 times just 50 years ago. Think about that jump. What that means for affordability, it's huge.
And medical debt, leading cause of bankruptcy. That's terrifying.
It is. Almost half of Americans can't cover a $500 medical bill without going into debt. $500.
Wow. And marriage rates dropping because people just feel they can't afford it.
Exactly. Down across almost all income levels, except maybe the very top. People delaying it or just not doing it because of money worries.
And then Gen Z, a quarter of them thinking they'll never retire. That's heartbreaking.
It really is. This isn't just abstract economic theory we're talking about. This is people's lives. It's stressful. Financial strain, the sources make it really clear, is this huge driver of divorce, depression, disability. It touches everything.
Okay, so with that kind of heavy backdrop, let's really get into it. Let's start with the foundation. Why even bother pursuing economic security? What's the real point? Because I think a lot of people just think, oh, it means having loads of cash.
Right.
Like Scrooge McDuck diving into his money bin.
Haha. Yeah, maybe. But it's much deeper than that. The source defines it really well. The time and resources to focus on relationships without economic stress. That's the goal.
Time and resources without the stress.
Exactly. You mentioned Bob Dylan, right? Money doesn't talk, it swears,
Hmm.
which is great. Classic Dylan.
Yeah.
But Galloway offers this nuance. He says, money's tone changes as it grows. Well, when it's scarce, when you're constantly worried about bills, it's yelling at you, right? Swearing, like Dylan said, reminding you it's not there. But as you build it up, as you get that cushion, it becomes comforting. It quiets down. It's about escaping that constant noise.
Replacing the shouting with calm.
Yeah.
I like that.
Precisely. It's about getting rid of that that pervasive kind of insidious stress that so many of us just carry around, maybe without even fully realizing it.
Like background noise you get used to.
Sort of. Think of it like high blood pressure. It's chronic. It's underlying, always there, humming away. And it makes you vulnerable. It can turn something minor, a small problem, into a massive, life-altering crisis.
And you said the source mentions actual physical effects, like on kids.
Yeah, it's not just a metaphor. Research shows kids in lower-income households actually have measurably higher blood pressure. The stress manifests physically.
Yeah.
And you see it ripple out societally. right?
Yeah.
Declining marriage, rising divorce, more depression, more disability. It's all connected back to that financial strain, that feeling of being constantly underwater.
There's also that stereotype of rich people, the
Yeah.
greedy cartoon villain like Monty Burns you mentioned.
Right, the conniving, selfish billionaire.
But Galloway really pushes back on that, and I found this perspective quite interesting. He says, based on his experience, most wealthy people are high-character humans.
Which is maybe counterintuitive for some people.
Totally. He describes them as, often gracious, hardworking, principled, pretty moderate in their spending, actually. Not necessarily flashy.
So chasing wealth doesn't automatically make you a bad person.
That's his argument.
Yeah.
In fact, he suggests those negative traits being immoral, greedy, selfish can actually get in the way of building real durable security.
How so?
Well, they erode trust, right? They close doors, they burn bridges,
Eh.
and ultimately they undermine the happiness you were hoping the money would bring anyway.
Which leads perfectly into this other really key idea, building allies, not just assets.
Okay, tell me more about that.
Well, just like you're told to save and invest early, the source says you should be just as intentional about cultivating allies, cultivating fans early on too.
So networking, is that what it means?
It's deeper than just networking, I think. It's about building genuine relationships, building trust. You want people to be like front of mind for you when opportunities come up.
A home field advantage, he calls it.
Exactly. It could be a job, an investment tip, a board seat, even just good advice.
Mhm.
Your network, your relationships, that's a massive form of capital.
Social capital.
Right. Because ultimately, the real goal isn't dying with the biggest number. It's living a life rich in relationships. That's the ultimate ROI, according to the source.
Okay, that makes a lot of sense. So we've covered the why. Why bother? It's about freedom, less stress, richer relationships. Now, the what? What's the actual target? What's your number?
Yes, the
Right.
algebra of wealth, the core equation, passive income greater than your burn.
Passive income greater than your burn. Simple concept, but probably tricky to figure out.
It is because there's no single answer, right? It's got to be a deeply personal exercise. It depends entirely on your life, your goals, your desired lifestyle.
So where do you even start with that?
You start with your burn rate, your annual expenses. Just try to rough out a budget. What does it cost you to live now? Or, maybe more importantly, what do you want it to cost you to live the life you aspire to?
Even if you're young, just starting out, seems daunting.
Even then, especially then, maybe, just make a rough sketch. It doesn't have to be perfect. It's a starting point, something you can refine over time as things change.
Okay, so rough out annual expenses, then what?
Then, taxes. Got to factor those in. Bump up your expense estimate by about 20% for taxes. Maybe even 30% if you live, or plan to live, somewhere like California or New York with high state taxes.
Right, always taxes.
Always. The source gives a concrete example. Say you figure out you need $80,000 a year to cover your burn rate comfortably today.
AK a year.
Then your number, your target for invested assets needed to generate that passive income. It's roughly $2 million invested today.
$2 million.
Yeah.
Okay, that's a tangible number, a target.
It's your security target, something concrete to aim for.
But there's always a but, isn't there? You mentioned tricks up capitalism's sleeve.
Yeah. And the biggest, sneakiest one is inflation. Galloway calls it the primordial foe.
Primordial foe. Sounds dramatic.
It is, because it's this relentless, quiet force that just erodes your wealth constantly, year after year.
Central banks aim for, what, 2%? Seems small.
It seems small, but the U.S. average historically is closer to 3%, and it compounds. The cumulative effect is huge.
So that $2 million target we just talked about.
If you're planning to hit that 25 or 30 years from now, inflation means your real target, just to have the same buying power, is probably closer to $5 million.
Wow, that's sobering.
Yeah. It is. Think about it this way. $100,000 income today. In 30 years, that only buys you, what, about $41,000 buys today. College tuition costing $200 now could easily be $360K when your kid is ready. Inflation is a silent tax.
Which is why you have to think in real dollars, not just nominal dollars.
Absolutely critical. Real dollars are inflation adjusted. They show your actual purchasing power. Nominal dollars are just the face value. Ignoring inflation, that's a huge mistake in planning.
And holding cash. Feels safe, but it's losing value too.
Definitely. Holding cash costs you 3% a year, compounded, the source says. It's bleeding value slowly. It's not a long-term wealth strategy.
So the mantra is,
Invest and run faster. Run faster than inflation. You have to.
you know that story Galloway tells about his son losing the ski glove? It really stuck with me
The blue glove in Courchevel. Yeah, it's a great one.
because the kid is just devastated, right, crying over this glove. And Galloway gives this, like, sensible dad speech about how things aren't important, relationships are.
Which is true, but maybe not helpful in that exact moment.
Right. But then they find the glove, by pure luck, hanging on a tree. And the kid's joy, the relief. It's not just about the glove.
No, it illustrates that whole high blood pressure thing perfectly, that underlying anxiety.
Yeah. How economic stress, even over small things, can just amplify everything and make minor stuff feel like a catastrophe.
And finding the glove, that relief, it symbolizes getting rid of that stress, the psychological freedom that comes when you're not constantly worried about scarcity. You can actually breathe.
Okay, so that really sets the stage. Let's move into the inner game. This idea that building wealth isn't just about spreadsheets, it's about character.
Yeah, that's a central argument. The distilled answer, he calls it. Those durable changes in behavior you need to build wealth consistently, they come from true character, not just good intentions.
Intentions aren't enough, like New Year's resolutions or forgetting thank you notes.
Exactly. We all intend well, but what we do is an expression of who we are. Building character is like building your defense system against, well, against being human and against capitalism's temptations.
And those temptations are strong because craving is in our DNA.
Oh, massively. Think about it. For 99% of human history, the biggest threat was starvation.
Right. So we're wired to want stuff.
We're wired for YNSN. You need stuff now. It's a primal impulse, way stronger than YOLO. Our brains crave sugar, fat, salt, because they used to be scarce and vital.
And modern capitalism just plays on that.
Ruthlessly exploits those ancient cravings, turning them into a desire for endless stuff, endless consumption. We're literally fighting our own biology when we try to save or delay gratification.
Wow. Okay, and then there's this attribution bias.
Yeah.
Overestimating success.
Yeah, or underestimating luck's role. Successful people tend to think, I did this all myself, which leads to overconfidence.
Making dumb mistakes after a big win.
Exactly. The junior exec day trading, the billionaire buying the sports team. The source warns, you were never more vulnerable to a huge mistake than after a big win.
And the flip side, if you're not successful, ignoring luck makes you think it's all your fault.
Which is just as damaging. It ignores fortune, random events, things outside your control. Understanding this bias helps keep you grounded, whether you're winning or losing.
And emotionally, managing reactions is key. Galloway talks about his imaginary scorecard.
Yeah, feeling the need to counterpunch every little slight. He realizes later, God, what a waste of energy.
So the stoic approach.
The indifference.
Controlling your response.
Yeah.
You can't control others, but you control how you react. His practice of casting people into the darkness sounds harsh, but it's about learning the lesson and then moving on.
Freeing up that energy.
Exactly. All that bandwidth wasted on resentment. Use it for something productive.
And speaking of productive, exercise. Non-negotiable.
Absolutely non-negotiable.
Yeah.
The link between regular exercise and health, success, happiness, it's just undeniable.
That stat about it being 50% more effective than therapy or drugs for depression, that's huge. It's incredible. Stephen Kotler says it flat out. Exercise is non-negotiable for peak performance. It's not just physical. It's mental clarity, resilience, energy. It helps you make better decisions, stick to the plan.
Even just starting small, like a walk.
Yep. Build the habit. Clear your head.
You know, it's funny. Life is just an accumulation of decisions, isn't it?
Totally. Which makes it weird that decision-making isn't taught formally, like in high school. It impacts everything.
Yeah, think about President Bush saying, I'm the decider. Truman's buck stops here. They had teams, but the final call was tough.
And for us, without that staff, having a framework, some core values to filter decisions through is even more critical. Being deliberate about how you choose.
Galloway shares his framework, right?
Yeah.
What were the key parts?
Yeah, it's insightful. First, market competition. What move creates the most value? What's the winning strategy? Second, listening to emotions, but distinguishing wisdom from, fear or greed, the amygdala going off.
Tricky balance.
Very. Third, seeking input from others. Don't operate in a vacuum. Get diverse perspectives. And fourth, the big one, making key decisions in the shadow of death. Memento mori.
Thinking about mortality.
Right. From that perspective, he believes he'll regret the risks he didn't take more than the failures from the ones he did. It pushes towards courage.
And then there's that really simple advice. Don't be stupid.
Haha, yeah, sounds basic. But he insists stupid is a thing. And it doesn't just hurt you, it hurts your network, your community, your ecosystem.
Because success depends on that ecosystem.
Deeply. High character people are more likely to succeed partly because others want them to. People are rooting for you. You attract support, not repel it.
Which ties into the power of small kindness.
Exactly. Big betrayals, team breakdowns, those take huge character reserves. But a lot of the time, doing the right thing is easy.
Like tipping well, holding a door.
Simple acts of grace. But they build the habit of generosity. They build the foundation you need for the big challenges because you are what you do. Your small actions define you.
Okay, let's tackle a big one. Talking about money. It's such a taboo.
It really is. But the source argues we need to talk about it more. It's the operating system of our society.
And Galloway suggests rich people keep it taboo so others might not learn something. That's provocative.
It is. But the point is, normalizing conversations about salaries, taxes, budgets, emergency funds, it helps everyone. You gather intel, you learn, you get better at managing your own finances, break down the secrecy.
And this is crucial in marriage.
Oh, absolutely critical. The stats are sobering. Divorce cuts wealth by about 3/4 for both people, on average.
About 3/4.
And financial disagreement. The #1 predictor of divorce, after just general tone of voice or attitude, it's the biggest thing couples fight about.
And just the lack of money causes strain.
Huge strain, higher divorce rates among lower-income couples. The source even pragmatically suggests marrying someone better at money than you can be a benefit. Complementary skills matter. Open, honest communication is everything here.
All right, let's shift to the earning engine, building your career. And this hits that controversial point head on. Don't follow your passion, follow your talent.
Yeah, this definitely challenges the usual advice. He says, kind of bluntly, if someone tells you to follow your passion, it means they're already rich.
So passion isn't the starting point.
Not according to this view. The better strategy. Find something you're good at, naturally good at, and then put in the thousands of hours of grit and sacrifice to become great at it. That mastery, plus the rewards and recognition that come with it, that's what leads to passion.
The tax law example. Nobody dreams of tax law.
Exactly. But the best tax lawyers, you bet they're passionate about it. The passion followed the expertise.
So how do you define talent then? It's not just music or math.
No, it's broader. What comes easily to you that's difficult for other people? That's the core question. It's like business strategy.
Yeah.
What can you do that others can't? Could be endurance, organization skills, communication, empathy. Lots of things count as talent.
And Galloway used his own story, right? Like rowing endurance at Morgan Stanley.
Yep. He wasn't the best finance guy initially, but he could outlast people. Worked those crazy 36-hour shifts. He leaned into his unique talent enduring pain, and it gave him an edge.
Some might call that hustle porn.
He acknowledges that, but frames it as leveraging a unique ability when others can't or won't. Then later, at NYU, his communication talent blossomed.
Teaching MBAs, which led to the newsletter, YouTube, podcasts.
Right. His talent flowered into his true career and then became his passion. It shows the pathway. Talent, effort, mastery, passion.
But it can be hard to accept where your talents really are, right?
Yeah.
Like the Johnny Lynn story.
Yeah, that's a great illustration.
Yeah.
He was brilliant quantitatively, but wanted to be the big picture strategy guy, the storyteller.
How to make peace with his numbers brain.
Exactly. And then he figured out how to use those quantitative skills to support broader roles like CMO and president. He leveraged his strength, then worked on his weaknesses. It's about being honest with yourself.
And a reality check on those passion careers. Acting. Sports.
Huge reality check. The competition is insane. Tens of thousands vying for a tiny number of spots. High risk of exploitation.
You need to be in the top 0.1% to make a living.
Pretty much. Whereas non-romance careers, the less glamorous stuff, 1,000 times easier to make a good living at.
So the advice is, get financially secure first.
And follow your passion on weekends. Or once you're stable. Don't bet your livelihood on a lottery ticket career unless you're truly exceptional and lucky.
Okay, now this idea of leveraging others' investments, like government funding.
Fascinating angle, right? Extreme wealth creation is easier for a firm that leverages government investment or fallow assets.
Silicon Valley being the prime example. Apple, Intel, Google, all benefited from federal R&D.
Hugely. He calls it maybe the most successful government investment in history. Same in pharma. 75% of new drugs start in publicly funded labs.
So as taxpayers, those investments are kind of ours.
That's the point. Yours for the leveraging. Look for opportunities that build on that existing public foundation.
And for many people, the best path might just be the corporate ladder. even if it's not sexy.
Yeah, the source makes a strong case for it. The American corporation is still the premier vehicle for wealth creation for most.
Better risk-adjusted returns than entrepreneurship.
For most people, yes. Corporations share values, salaries, bonuses, stock. Navigating the politics, the frustrations, it can be tough, but the climb often leads to significant, stable rewards.
Like his Morgan Stanley colleague who ended up vice chairman with less stress.
Exactly. Similar outcome, much smoother ride. It's a valid, often safer path to wealth.
Let's touch on those specific career paths mentioned. Academia.
Galloway clearly loves his NYU affiliation, calls it a great gig, good environment, flexible schedule, deep knowledge focus.
But limited upside, the high income trap.
Yeah, often salary-driven. And that tax trap is real. High earners in the mid-six figures can feel the pinch of marginal tax rates quite heavily, sometimes more than millionaires proportionally.
Management consulting, good training, interesting work.
Definitely. Exposure to lots of industries pays well. But hard to scale your selling your time. Physically and mentally taxing.
Often an on-ramp to something else.
Usually. He calls it a career for the elite and aimless, talented folks who haven't quite figured out their long-term plan. Great training, though.
Finance, that's where the crazy compensation is.
That's the perception, often the reality, because nothing scales like the money business. Moving capital is easier to scale than moving people or services.
So high demands, but potentially unmatched ROI on your effort.
If you have the grit and talent for it, yes.
Yeah.
The potential returns are huge.
And the pilot example really drives home that talent versus passion point again. Loves planes, owns a jet.
But knows he doesn't have the talent for flying them professionally.
Right.
The immunity to boredom for routines, the rigid protocol following in a crisis.
That Cobra story, wow.
Right. Discipline and training save the day, not just passion for flying. Knowing your aptitude is key.
Okay, best practices for getting ahead. First, get to a city, go to the office, especially early on.
Crucial. You need the training, the mentorship, the challenges you get in person. Virtual just isn't the same for building foundational skills and relationships.
Being in a city forces you to compete with the best.
Yeah, rally with the best. And being in the office lets you build real connections, find mentors who get emotionally invested in you.
And remote workers are less likely to get promoted, more vulnerable to layoffs.
Stats seem to bear that out. Easier to cut someone you only know through a screen. Physical presence still matters, especially for advancement.
Next concept, gravity problems from designing your life.
Right. If you can't fix it, you have to stand it. Problems you literally can't do anything about.
So if it's not actionable, it's not a problem.
It's a circumstance, a condition of life. This saves you wasting energy fighting unwinnable battles and helps you know when to quit or pivot.
Which leads to the art of quitting. Reframe it as strategic.
Exactly, like pivoting in tech. Kenny Rogers knew. Know when to hold 'em, know when to fold 'em. Successful people quit strategically, often.
Plan your exit.
Yep. Plan your out before you get emotional. Makes the decision rational, not reactive.
And strategic job changes are often how you get big jumps in pay and responsibility.
Often, yes. That sad truth that outsiders might value you more.
Galloway using offers as market checks at NYU.
Right. You have to show a credible willingness to leave sometimes to get your true market value. Younger generations seem to be doing this more, switching jobs faster.
And finally, elite education still carries weight. Graduates earning significantly more.
The data suggests it does. That institutional reputation, the network, it provides a tangible advantage. Not the only way, but definitely an advantage.
Okay, shifting to the actual money machine, investing principles, and the core idea. Time is the real currency.
Absolutely fundamental. Money measures wealth, but time is wealth. Everyone gets 24 hours, no refunds for time wasted.
But our brains are bad at understanding time, faulty heuristics.
Yeah, we're terrible at it. That vacation example. Losing a day from a 9-day trip feels different than losing a day from a 3-day trip, even though it's the same amount of time. We foreshorten time.
Near future stuff feels bigger.
Right. And memory bias in investing, we remember the wins more than the losses, leading to overconfidence.
So the goal is to maximize time for productive things, work, learning, relationships.
Exactly. Which brings us to social media, called a great wealth destroyer. Ouch.
Why? Because it steals time.
Precisely. Robs young people, especially of time they could be using to build skills, work deeply, cultivate real connections. That study ranking it last for happiness is telling.
The tip, log out of apps. Make scrolling a conscious choice.
Yeah, adds friction. And remember, time management is a skill beyond apps. It's about ruthless prioritizing.
Like Galloway's pre-appearance focus, oblivious to the hotel name.
Extreme example, but it shows dedicating finite time to the highest value activities.
And the irony, young people are time-rich but often squander it.
It's true. The advice isn't don't have fun, it's recognize the value of that time. Use it for enjoyment, yes, but also consistently save and invest. Let compounding work its magic over decades.
Then, measure to manage. The Hawthorne effect.
What gets measured gets managed, like tracking fitness or food intake. Same applies to money. Track spending, track savings. Frequently, detailedly.
Even on low income, throwing nickels around like manhole covers. Being deliberate.
Yep, and gamify saving. Make it a challenge. Make it fun, like they did with the Sizzler budget.
For goals, set realistic short-term ones, not just lofty long-term ones.
Research shows that works better. Aim for what you can save this month. Achieving small goals builds momentum.
And challenge mental accounting. Money is fungible.
Yeah. Don't get too rigid with those separate buckets, emergency, down payment, etc. Money is money. Be flexible.
Use the emergency fund for a house down payment if needed, then rebuild.
Exactly. Don't miss a great opportunity because you're stuck on an arbitrary figure in one mental bucket. Use the money wisely, then replenish.
Okay, understanding the basics of capitalism. Money is exchanged time.
Your work time for someone else's time, the bartender, the farmer. But not all time is valued equally.
The Cristiano Ronaldo example. Stark but true. Supply and demand.
Right. Free markets use supply and demand for pricing. Inefficient markets create arbitrage opportunities like those Levi's jeans back in the day. Buying low where info is scarce, selling high where demand is known. Arbitrage actually makes markets more efficient over time.
Financial markets price capital. Interest is the price of money, or price of time.
Yep. An investment is giving money now, hoping for a return later, because someone else thinks they can use that money productively.
Corporations are the main users of capital, legal structures, aiming for rationality.
Theoretically, pooling resources, using rules and accountability to make more predictable, logical decisions than individuals might.
And financial institutions, retail banks, investment banks, brokerages, investment companies all play different roles.
Facilitating savings, large transactions, individual trading, managing assets like 401k, parts of the ecosystem.
And government's role is huge. Rulemaker and enforcer.
Setting the ground rules via regulation, law, taxes. Finance isn't separate from government. That's a myth.
And also a massive participant. The U.S. government's debt makes it like a whale in the market.
Its moves create ripples everywhere, influencing rates and behavior globally. Its size gives it enormous power.
Key metrics to watch. GDP focus on the rate of change. Declining GDP is recession risk.
CPI tracks inflation via a basket of goods, shows how fast your money is losing purchasing power.
Unemployment rate, labor market supply-demand. Low unemployment usually means rising wages. Full employment around 5%.
And interest rates, the gravity affecting everything. The federal funds rate is the floor, the risk-free rate for lending to the government.
Which brings us to valuation. Price versus value. Price is easy, value is harder.
Right. Value is about expected future money production. Key factors: future cash flow, terminal value, what it's worth when you sell, and risk uncertainty.
Opportunity cost money now is worth more, leads to the discount rate.
Exactly. The discount rate combines riskiness with how long you wait for cash. Riskier, longer-term stuff gets discounted more heavily today.
Stocks, equity, the core investment for most. Ownership gives control, voting, and economics, profits, appreciation.
For most individuals, it's about the economics dividends, but mainly price appreciation. Buying below value, hoping the market catches up.
Understanding financials is key. Income statement is like a river of money.
Revenue flows in, expenses, cost of goods, operating expenses like SG&A, R&D, divert it, leaving operating profit. EBITDA adds back non-cash stuff like depreciation.
But you have to understand the real business. Google isn't a search company.
It's an advertising company. Sells attention gathered via search, YouTube, etc. Knowing the actual business model is crucial for valuation.
Okay, warnings, day trading.
Bad. The more you trade, the more you lose. Exhausting, tax inefficient, just don't.
Employer stock received as compensation.
Sell it. As soon as you can, tax efficiently. You're already way too exposed to your company. Diversify that wealth. Ask yourself, would you buy this stock with cash? Probably not.
Bonds, the predictable alternative. Less risk, modest but steady returns.
Yep. Lending to companies, governments, predictable payments, capital back at the end. Trade-off is very little upside potential compared to stocks. Good for stability.
Real estate, improved asset classes. Good long-term forced savings.
But a life stage decision first, investment second, highly localized, and that mortgage interest deduction isn't as beneficial for most people as it used to be.
Commodities, currency, derivatives, the
Yeah.
fringes.
Raw materials, foreign money, derivatives, futures, options, or complex leveraged bets. Mostly for hedging risk or, more often for individuals, high-risk speculation. Handle with extreme care, if at all.
And the final boss, the tax man. Professional advice is key.
As income and investments grow, yes, good tax advice is one of your best investments. It pays for itself many times over, prevents costly mistakes.
Income tax basics. It's a percentage, but complex. Most don't itemize deductions.
Right, so common deductions often don't help the average person.
Yeah.
And remember, deductions reduce income, not taxes directly.
Graduated rates, the high income trap where mid-six-figure earners feel the marginal rates most acutely.
Yeah, due to how the brackets work, declining utility of money, and those expenses of prosperity hitting that zone hard, it's counterintuitive sometimes.
Timing is the most important tax dynamic. Goal. Lowest lifetime effective rate.
Exactly. Defer income from high tax years to lower tax years using things like traditional IRAs, 401k, saving 27 cents on the dollar just through timing. That's huge.
And moving states can save 10% plus of gross income.
A massive factor for high earners. Moving out of high tax states like NY or CA can dramatically boost your net wealth accumulation over time. Worth considering.
Finally, diversification. Your financial Kevlar. Not just different assets.
It's broadening risk, so no single failure or global shift can fatally injure you. Building resilience.
Galloway's red envelope disaster. Lost 70% being too concentrated, too emotional.
Painful lesson. Miss the flashing red lights. Proves perfect storms are rare, but they always happen. Diversification protects you.
The Warren Buffett bet. S&P 500 index fund crushed the active hedge funds.
Yeah, 126% is 36% over 10 years. Clear proof that very few, if any, consistently beat the market long term.
Wall Street's secret. Over the long term, no one beats it.
The power of passive, low-cost investing in the broad market is often the winning strategy.
But the S&P 500 is volatile, not for short-term needs.
Definitely not. Long-term growth, eat passive, diversified. But intermediate money needs careful management of that variability risk. As you get wealthier, you can maybe take more calculated risks for higher potential upside, beyond just tracking the index.
Okay, wrapping up. Key takeaways. Economic security is about consistent action, not just planning.
Matching actions to intentions. It's about behavior patterns.
Building long-term character as your defense.
Against human weakness and capitalism's siren song.
Slowing down, making conscious decisions. I am in control.
Asserting that choice in the moment.
Prioritizing fitness, sweat. Buys you health, focus, time.
Undeniable link to success and happiness, non-negotiable.
Making good decisions, review, learn. Regret risks not taken more.
Embrace calculated courage.
Being a good citizen in your ecosystem, don't be stupid. Network health matters.
People root for high-character humans.
The power of focus saying no. Simplifying.
Concentrating energy where it counts.
Valuing returns by probability and time. Money now, money later.
Wow.
Reliable, unreliable.
Core financial logic.
Smart investing.
Hmm.
Mostly passive, diversified ETFs. Small amount for active learning, not day trading.
Learn by doing, but protect your core wealth.
Home ownership. Life stage first, investment second. For savings, portfolio anchor.
Practical approach.
Vigilance against fees and taxes. Always factor them in.
They significantly alter returns. Understand the tax implications.
Timing taxes.
Okay.
Use deferral, traditional IRA, 401k,
Yeah.
or tax-free growth Roth strategically.
Huge long-term impact.
Look beyond obvious careers. Follow talent, not just prestige. Opportunities exist outside the usual paths.
Find where your unique aptitude fits.
And above all, be present. Master the now to build the future. Change the timescale of your life, and you change your life.
Profound. It really is about consistent present action building towards that long-term security.
Absolutely. So that really brings us to the end of this deep dive. What's consistently clear is that economic security isn't just numbers. It's about those intentional choices in character, career, capital that buy you time, freedom, peace of mind.
Yeah, the stuff that really matters. So maybe a challenge for you listening. Think about one gravity problem you've been fighting. Something you might need to strategically quit or reframe. What is it?
Or, maybe simpler, what one small daily habit related to time or money can you start consciously measuring? Starting today, just one thing.
And a final thought to leave you with. If wealth is ultimately about buying back time for what matters, what's one non-financial measure of wealth you're going to prioritize and fiercely protect starting now? Your health, relationships, peace. What is it for you?